all of those factors are very important, because if you don't have all of those in one place, then you don't have control. If you don't have control, then you've got nothing to sell.
Hey there, Jeff Barnes here again with another episode of Angels, Exits, and Acquisitions. Really excited to have you here today. And we're talking with Michael Charles today about intellectual property and valuing companies, both on the buy side and the sell side, or if you're an entrepreneur on the raising capital side, and if you're an angel investor on the how do I look at a deal and see what the value should actually be and what I should be investing in. It doesn't make sense for me. So a lot of really great nuances here. Now, we could have gone hours and hours on valuation and how do you increase valuation. We spent a little bit of time talking about intellectual property. How do you value it properly? How do you figure out what you should invest into a company based off of the intellectual property? And then some really key and important risk factors you need to acknowledge, whether you're raising capital or investing in or acquiring a company. Really important to look at these. So look forward to hearing about your thoughts and ideas. And as always, like, subscribe, and share, and look forward to hearing what your comments are. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
Hello, and welcome back to another episode of Angels, Exits, and Acquisitions. My name is Jeff Barnes. I'll be your host today. I'm here today with Michael Charles. Michael, how are you?
I'm good, thanks, Jeff. How are you?
Doing great, doing wonderful. So you're calling in from London, so you're wrapping up your day. I'm getting my day started here. It's always fun to be able to do these things internationally and hear what people across the pond are saying and talking about. So I'm really excited to have you here today.
Thank you. It's a pleasure to be here.
Wonderful. So before we get going into anything, why don't you tell people a little bit about yourself, give them just a brief couple-minute background on you and kind of where you are today.
Okay, I'm 58 years old. I'm based in London, fairly well traveled. I'm a family man. I have 4 grown-up children and a grandson. And my background is business. And I have, as an entrepreneur, I have various different interests, various different investments, various different companies that some are boutique and some are quite specialist. But my field of expertise is intellectual property.
Beautiful. And so intellectual property. Now that has a lot of meanings for a lot of people. And one of the things that I have heard time and time again throughout my career is that we undervalue our own knowledge and expertise. And that's a form of intellectual property. But why don't you tell folks a little bit about intellectual property, what that really means and what it means specifically in your world when you're talking about valuations and creating value around intellectual property?
Well, to begin with, when I was studying business at college, I ended up working with a small company that specialized in valuing assets. So we were looking at all kinds of commercial assets, and that included goodwill, and that included know-how. I'm going back 35 years, and a lot of the time people were uncertain about how to assess or determine or even put any kind of figure on know-how, but it's something that is intangible. We were looking at property, commercial, manufacturing, engineering, retail and wholesale. We were looking at businesses across the board. And one of the things that was critical was know-how, goodwill, brand names, trademarks. And so we spent a lot of time looking into them, researching them, looking at the cost of acquiring them, looking at the cost of developing them. So when you talk about intangible assets, one of the key questions is how long it would take or how much would it cost to replicate something that you've already designed, developed, or achieved. And there's a lot of historical data that you can look at to try and project what that value might be. A lot of historical trading information that will help you, and projections and forecasts in the future. But we have a team of experts that we work with, from actuaries and other professionals, accountants, and other experts to help us fill in the gaps where we might not have all the information. But intellectual property can be made up of all kinds of different things.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Yeah, and you use the word goodwill. And I remember when I was going through my MBA and I was learning about how to value companies and looking at P&Ls and balance sheets and all of this stuff that we're trying to figure out what the enterprise value of a company is. I saw this line goodwill on balance sheets over and over again. And no one could really describe it properly to me in a way that I was satisfied with, right? Because it just didn't make sense. The first time you hear about goodwill, I'm thinking, here in the States, at least, goodwill is a nonprofit organization. Like, not everybody can call goodwill, part of the thing. But, goodwill is something that does get valued in enterprise level organizations. Can you maybe and we also refer to a term called brand equity, right? The value of your company over and above just the physical assets. I believe that's what you're really referring to here. And like you said, going in and valuing it, that's, it's more of an art, I think, than it is a science.
A lot of the time, we were being asked to value companies and assets in certain situations. We were being called in by insolvency practitioners or banks or company directors when the companies were in distress. And a good way of explaining goodwill would be if the company had pressure, and if you had a manufacturing facility that was operating in a large commercial property, and you had a power cut, and without any power, you had to try and recover an asset value for the business, try and sell the business. Well, if you had to strip out the contents of that property, you would get a certain amount of money for it because it would be a distress sale. But if you had the opportunity to sell that company and turn the power back on, flick a switch, for instance, and start manufacturing again at that point, then you could use that as an opportunity to describe what goodwill actually is, because it's all about circumstance, it's all about timing, and there is a magic to it. If you have the ability, if you have time, and you have the ability to sell something, then you can achieve a very different outcome.
It's the classic example of the sum is more than its parts, right? Being able to put it all together creates something that is much more valuable than if you just had them independently.
That's correct, yeah.
Now, one of the things that when I was younger in my career and I worked in a big corporation, I remember going up for interviews and, trying to get promoted and things like that. And they would ask me a question, which was, what do you find to be the biggest challenge with our company right now that you could help support? And for me, the biggest challenge that I saw was that we had people that worked for the company for 30, 40 years and massive amounts of intellectual property stored in their brains that had not really been transferred in, knowledge transfer to the next generation of workers, right? We had plenty of standard operating procedures. We had all the systems and tools. I mean, we're a multi-billion dollar company. And when I would describe that and I would talk about this, people would look at me like I was crazy sometimes, and some people actually got it. But how do you guys assess, when you're looking at intellectual property, how do you guys assess the individuals within an organization, or a key person, right? So the founder, the CEO, the really smart person that has all the wires and everything, all the schematics in their brain versus the actual businesses.
When we're involved in a transfer of a business as a going concern, if you like, we're dealing with M&A companies or PE companies, where you have key individuals who are greater. Their value is that, they could be the chairman, they could be the CTO. Where their knowledge and experience is critical, you would tie them into a contract for an extended period of time for a handover so that they would have the opportunity to pass on their knowledge and introduce them. It'd be a hand-holding exercise where they would introduce the new management to the clients. So that's the way that you would address that. But business and industry, it changes so quickly, and never more so than in the last 20 years with the internet and the advance of technology. It's almost breakneck speed, and you really have to move very, very quickly with technological advances.
Yeah, and I think that's a really critical point when you're looking at an investment or an acquisition of a company, is where the intellectual property is, where that knowledge is, where the core value proposition of a business is. And so if I was to flip that on its head and say I'm the entrepreneur raising capital now, how do I use that to my advantage?
Independent valuation is critical for a number of reasons. If you're looking to raise funds, we can help capitalize the value of the intellectual property by valuing it and by putting it onto the balance sheet. A lot of the time, companies will have IP. It could be a software platform, and they may have spent on research and development many millions of pounds or dollars, but it hasn't yet been capitalized in the company. So an independent valuation would help you achieve a greater value of the company because it converts it from being simply a liability to an asset. And that's what we can do.
And so the US, I think we call that the 409 alpha valuation. It's independent private valuation. I don't know if it has a different term or name overseas, but a 409 alpha valuation is that independent value of the company. And when you're going through this valuation process, obviously you've probably done hundreds, if not thousands of these. How does somebody, again, I help a lot of companies with their capital raise, and we also have a lot of investors looking at it. And so the investors are always trying to get the lowest valuation so they can get, the most for their money. And the entrepreneurs are always looking for the highest value.
Maximum value because they want to enhance the value so that they can raise more money or lend or get some debt against it from the bank, which is another.
Yeah. So how do we build that value up?
Well, a lot of the time it's very important from a valuer's perspective to understand the rationale behind the valuation. What are you trying to achieve? If your instructions are coming from an insolvency practitioner, he's looking to understand what is he going to achieve in the worst case scenario. If you're looking for an exit strategy, or if you're looking to raise capital, they're trying to maximize the value of the asset. So from a valuer's perspective, it's very important to understand the instructions from the client. Once you get those instructions, if you're looking to demonstrate maximum value, one of the critical things is to determine what is the value of the market capitalization and what is it possible for this potential new product to achieve in terms of a market share. And then we would apply a certain process to determine value.
And, I have so many questions about this whole process. I go through it myself, and we're trying to value companies that we're acquiring or investing in directly. And of course, we have a certain modicum of success with that, but this is not our normal field of expertise, is just valuing companies. And so when we're looking at a company, we're looking at a lot of different things, right? The team, the risk factors that are out there, the market penetration, the market share that they might have, the addressable market, all these different things kind of go into our assessment of a company's value. And of course, entrepreneurs are always saying, well, in 2 years, I'm going to make, $1 billion, right? And so that's what I'm trying to assess my value on. And we always try to say, no, we have to assess where it is today and maybe give you a little bit of a bump for the future potential. But future potential is often meaningless today, especially when we're talking earlier stage companies. Future potential can be great when you're, maybe in a larger company. Like we look at, there was an acquisition that was conducted just recently, and actually the Dodgers, right? So the Los Angeles Dodgers, a sports team, at the time that they were purchased, I think it was $2 billion. If I'm not mistaken, it might have been $4 billion. I can't remember, but everybody thought that they overpaid, right? And it's a sports team. Like, how can you make that money kind of come back? And then what they didn't realize was the potential of ongoing marketing, ongoing advertising, profit share, revenue share from different joint ventures, network access, all these different things that made it worthwhile.
Yeah. Yeah.
So do you guys look at stuff like that, or do you guys advise people on how they can leverage that to increase their value on an exit?
Yeah, we would do. If that hasn't been properly explored, then on the one hand, you're saying that it was considered that it was oversold, but in reality, once they had explored all of those different marketing opportunities, it turned out that they could actually have paid more for it. So it's like anything. It's like looking at any kind of business. If you put it into the right hands, it has a greater value. One of the starting points, if you're looking at small to medium sized companies, is the question you would ask is, what would it cost to replicate something?
Right.
So that's your starting point before anything else. You're always going to have a range of values, and a lot is determined by the circumstances surrounding the sale. There's always more than one value. So it's important to understand, going back, what is the purpose of the valuation? What are you trying to achieve?
And I'm assuming that the valuers, the valuation company, whoever's doing this, is an independent third party. And it's not like here in the U.S., we laugh at the real estate market. People will say, okay, well, I want to buy that house and I've got pre-approved by the bank for $500,000. So I need to make sure that the value of that house is at least $500,000 so I can get the loan, right? Because if it's less than that, I'm not going to get the loan for $500,000 and so on. And we saw this happening during the financial crisis. In some cases, we're still seeing it today, where the valuation person is like, okay, well, if that's what you need the value to be, okay, we'll look at it and say, yep, it's pretty close to that or above that or whatever. And there's a lot of people that are unscrupulous when it comes to that. But my guess is that when you're doing this, there's either going to be one independent third-party valuation company, or the sell side and the buy side acquirers, the acquisition company will probably have their own independence. Is that how it's kind of working?
It's subjective, and I think that real estate has a set of parameters and guidelines which specifically set out the value of a property. It could be based on square footage. It could be, a lot is determined by the location of the property. There is comparable real estate. There is ample and sufficient evidence, certainly in the UK, definitely, and in Europe, where you can look up the value of properties that are being transacted upon. So I think real estate is a bit. It's more direct. It's more straightforward. There are more comparables. I think when you're looking at a software company in a space where there aren't that many competitors, if it's an emerging product, it's far, far more difficult to assess.
Okay. Yeah, absolutely. So can you give us an example of, maybe a company that you helped on the exit side where you guys came in, you gave them a value, and maybe the value that you came up with was completely different than what they had originally thought, and kind of walk us through that a little bit?
There are many, many examples, a lot to do with timing. We've dealt with companies that were in distress, where we had a willing buyer for the property, and the value that they were prepared to pay for the property grossly outshadowed the actual value of the business. Those are extreme circumstances, but real estate is another example where we sold a property for 8 times its value, because it happened to be the last property in a potential development, and it held the key to unlocking the development for the developer. These are extreme examples, but generally speaking, we've looked at companies that had intellectual property and libraries of assets that were grossly understated, and we've achieved maybe 20 or 30 times the assessed value through our involvement.
Oh.
And a lot of that is to do with our experience, our know-how, the teams that we put together, the ability to negotiate and manage, and also market to specific and the right target audience.
So have you ever done any valuations on companies that have gone public and gotten listed on stock markets anywhere?
Nothing that I'm able to talk about.
Okay, fair. And the reason I'm asking that question is because when a company goes public, a lot of times they will increase their value so that they can get a share price that they really want, so they can raise a whole bunch of money during that initial public offering. And unfortunately, what ends up happening in a lot of cases that we see is there's a massive surge when the public gets in because they're excited about it. And within days, if not months, that stock price tanks because for whatever reason, the market now says, hey, it's not actually worth that much. And then, like I remember Tesla. So when Tesla went public on day one, I bought some shares of Tesla, not a lot, but it immediately went down. And I was like, oh, geez, great. So happy I did this. And it's, of course, rallied like crazy since then. But I'm just curious about when you're working with earlier stage companies, non-public companies, and they're looking at the intellectual property, we're looking at evaluation, what are some of the key critical success factors or IP aspects that investors should be looking at and making note of that would really help them assess the risk and the potential for increased value down the road?
I think the example that you were talking about earlier with was it the Dodgers you mentioned?
Yeah.
Mm-hmm. Yeah. So if you take that scenario where you have a group of investors looking at making an acquisition and seeing other opportunities which they felt that they could capitalize on, it's simply a case of matching the right buyer with the opportunity, and if there are economies of scale to be gained because there's synergy between the buyer and the seller and opportunity that exists, then you may well overachieve what you're asking for. So yeah, I think every single situation that we're called into is completely unique. And, when we go through the discovery process, it's very important that we fully understand all aspects. And over time, I think that discussing the fine details with the directors of the company is critically important. Understanding and securing IP is another huge area where there is a lot of confusion. But securing the IP, understanding who the key individuals are, if we're talking about software, and providing continuity through the various different stages is absolutely key. Because if you can't keep your IT team in place, then you're heading for serious problems.
So can you dive into that just a little bit about what you mean by securing IP?
So you need to understand who the author of the code is. You need to understand where it's located, who has access to it, who has claim to it, where it's registered, how it's been paid for. All of those factors are very important, because if you don't have all of those in one place, then you don't have control. If you don't have control, then you've got nothing to sell.
So I think of the case of Parler, right? A social media platform that came up and was up and coming and making millions and raising millions. And then with the flip of a switch, the very next day was gone because the servers were not theirs. They were on somebody else's. And all of a sudden they didn't like it, shut them down, they were gone.
Yeah. So, I mean, that's a classic example of protecting your IP. If you don't have control, then you're completely vulnerable.
Yeah.
So
I used to do.
you need to take control of that. You need to make sure that that your data centers are not creditors, because they could take possession of your hardware if you haven't paid for their services. It seems to be pretty obvious, but a lot of people don't prioritize.
Yeah, it's a pretty big thing, right? If your entire business could be shut down by one or even a couple of other entities. I mean, never mind government risk. That's a whole other topic. But yeah, it's a big thing. I used to do risk analyses of businesses a long time ago. We would always look for dependencies and interdependencies, right? And then, of course, contingency plans and backups and all of these different things, specifically for, what is the risk? Because if you have, let's just say, one supplier to your business, and if that one supplier goes out of business, that one, they decide to shift over to somebody else, you lose that contract, whatever that ends up being, if that can control your output in your business, that's a really risky place to be.
Agreed.
Well, Michael, we're coming up on time right now. I really appreciate this. This is a great conversation. And anybody who's interested in learning more about you, where can they find you?
Yeah, we're online, amco-agency.com. You can contact us if you've got IP that you consider to have more value than you're currently showing or demonstrating. We can help you with regards to funding, possibly exit. And we're always available if there are any insolvency practitioners that are sitting on some high value IP but don't know what or how to deal with it. We'll deal with, we've dealt with many cases internationally in the US and throughout Europe, obviously. But by all means, make contact with us, and we're here to help.
Beautiful. And we'll make sure we put all of that information in the show notes. So, Michael, thanks so much for being here again today. I really appreciate it. And we look forward to getting this out there. And for those of you guys that are watching, listening, make sure you like, subscribe, and share. And then, of course, check out the show notes for more information. Thanks again, Michael.
Thank you, Jeff. Take care. All the best.